and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to do something a little different, and rather than look at past developments, we're going to try and read the tea leaves for you. GDP data for the second quarter of the current fiscal is due later this month, on the 30th of November to be precise. And so, in this episode of Macros with Mythili, we're going to try and look ahead to what to expect the coming Wednesday. And joining me in the crystal gazing effort are two macroeconomists who keep a close watch on the economy. Pronab Sen, Country Director for the International Growth Centre's India Central Programme and former Chief Statistician of India, and Abheek Barua, Chief Economist, HDFC Bank. Welcome to the show, Pronab. Abheek. Pronab, the first quarter performance was seen as disappointing by many observers. GDP growth at 7.1% was not only the lowest in the past 6 quarters, but was also lower than the 7.5% achieved in the comparable quarter of the previous fiscal, even though the gross value added was marginally higher. Will second quarter numbers be better or worse than the second quarter numbers of the previous fiscal, which came in at 7.6, and why? And I'm referring here to the GDP, not to the GVA, as the former seems to have more salience. We'll come to the issue of which is a better measure of economic activity a little later if we have time. But for now, I want to draw you in on your estimate of the GDP number for the second quarter of this fiscal.
My estimate is that the actual activity in the second quarter was a lot better. But the way we measure things, most of that gain will actually show up in the statistics only in the third quarter. And that's because of the effect of the festive season. So what generally tends to happen is before the festival season, production is made, it's kept in inventories and gets released at a later date, which would all happen in the second quarter itself. Unfortunately, the way we measure it is that as far as the IIP is concerned, we actually don't measure production. We measure the dispatch of production from the factories. And similar is the case with the quarterly results. There again, it is based on turnover and sales rather than on production itself. So my suspicion is that what you're probably going to get is a GDP number which will be, of course, higher than quarter one. I think quite a bit higher, probably somewhere close to 7.5. But whether it will be faster than second quarter last year, that's difficult to say.
Abheek, would you agree? And for the same reasons that even though economic activity has held out quite well in the second quarter, we'll see the results of that only in the third quarter. Of course, this third quarter we might find some other factors such as demonetization. But would you agree with Pronab that 7.5 seems a reasonable number to expect?
No, absolutely. And let me remind you that the first quarter's GDP number was depressed by the fact that the subsidy outgo that differentiates the GVA from the GDP was particularly high, and consequently GDP came in much lower than GVA. What I believe is that not only were the levels of activity higher in the second quarter, it will actually reflect in a better GDP number, and my number is actually a little more optimistic than Dr. Sen's. I have a number of about 7.8%, and there are a couple of issues that I must mention here. There are base effects, favorable base effects at play in a number of segments, agriculture being one of them, mining and quarrying being another. So given if you take the amalgam of all these things playing out, then you should get a number of around 7.8% for GDP. And this time, unlike the last time where the GVA growth rate was higher than the GDP growth rate, you might see a situation, because the subsidy outgo has declined substantially, you might see a situation where GDP growth is higher than the GVA growth. The problem area, I think, is manufacturing, that might see a little bit of moderation in value-added terms, and I'm not going by the IIP, but other proxies like profits after tax and so on that have correlated well with the manufacturing value-added. But that is sort of offset by a number of other segments, as I mentioned, mining and quarrying. I think services should have done reasonably well. So I have actually a fairly aggressive number of 7.8%, which I think is broadly sort of the number that's doing the rounds of the market from what I understand.
Okay, so 7.5 from Pranab, 7.8 from Abheek, but both quite satisfactory certainly. But Pranab, I know I said we'd be discussing the second quarter GDP expectations, but over the past few days, post what has come to be termed as demonetization, though it's not a strictly correct term, many banks and brokerages have actually reduced their GDP estimates for the third and fourth quarters. In fact, one of them has slashed GDP growth for this fiscal by over 3 percentage points, saying that Q3 GDP might actually contract. Do you foresee such a dire situation, Pranab?
Mythili, it's possible, and much depends upon what happens to the Rabi sowing. Although the Rabi sowing effect will actually show up primarily in the fourth quarter, but nevertheless, I think there is some cause to believe that the GDP may actually contract.
Okay. Abheek, do you share those fears, and if so, why?
No, absolutely. I think demonetization certainly has been disruptive. India is a cash-intensive economy. That does not necessarily mean that we are a large untaxed economy, but for for large segments that have remained cash intensive, the motivation might not entirely have been tax evasion, but simply legacy issues like penetration of payment systems and so on. Agriculture is one such sector. You have transportation, construction and so on, where there is sort of this mix of black in the negative sense of the word and a cash untaxed economy in a sort of a more positive sense, in the sense that that's how things have evolved. And you've hit an economy where these segments are critically dependent on cash for their activities. So there is bound to be some impact. I don't think I have either the data or the analytical apparatus to figure out how much the hit is going to be. But certainly it would be prudent to go with a reduced GDP number for the third quarter. And perhaps there will be some spillover into the fourth quarter. So the second half, because of demonetization, will possibly look worse than the first quarter. How much worse is anybody's guess at this stage. It's a function of how well the system is remonetized, replenished with cash and so on. But certainly there is no doubt about the fact that there would be a demand problem as well as a problem with a number of supply chains. So it's a combination that is potentially reasonably contractionary for the economy.
So both Abheek as well as Pranab have doubts about the impact of demonetization and what it's going to do for GDP numbers in the next coming quarters. And that's not very good news. But Pranab, one of the biggest puzzles that we've had with GDP numbers following the change in methodology is a huge disconnect between industrial activity as measured by the index of industrial production and by the GDP numbers. We have no means, of course, of determining whether there is a similar disconnect in the case of agriculture and services, simply because we don't get monthly data on the performance of these two sectors. But at least anecdotal data and other high-frequency data does not suggest that there is so much variance between the final numbers here. So I have two questions for you. One, should one believe the IIP data or the GDP data to assess the performance of industry? And two, will this disconnect remain till such time as the IIP data is recast on the same lines, that is, the base year is brought forward and so on?
Yeah, I mean, frankly, the IIP data has two serious infirmities. The first is that it is way out of date. It's based on 2004-5 and really hasn't picked up the huge diversification that took place in Indian manufacturing between 2004 and 2009, where we were a 9% plus economy. Well, that disconnect apart, the second issue is that the IIP data simply does not pick up any improvement in productivity. And the data that we are getting from the company accounts suggests that there has been a significant productivity improvement across manufacturing, and this is for all sizes of firms. So therefore, at the moment, I would tend to prefer the company account data to the IIP. And when the revised IIP comes out, which is going to be based on 11-12, we'll again have to take a look at how closely it corresponds to what the company records are telling us.
Abheek, as chief economist of HDFC, GDP numbers as also the sectoral breakup is very critical for you to advise the bank when it's drawing up its lending strategy. So what are you guided by, IIP or CSO numbers? And would you agree with Pronab that CSO is a better indicator, those numbers? And what are you expecting to see next Wednesday? In the first quarter, we saw CSO give us a much more robust picture of industrial growth and of manufacturing in particular, with CSO assessed at about 9.1, while IIP actually showed manufacturing activity contracting. This time also, the IIP for the first half actually contracted by 0.1. So what can we expect to see from the CSO? Better numbers or more or less in line with IIP?
Well, I think the revision in the GDP numbers came as a bit of a surprise to us, especially the fact that the growth rate picked up so substantially. We are principally interested in credit growth. So instead of trying to figure out what the problem was, or being nitpicking about the data, or being too critical about it, we recast our credit growth and GDP relationship, and we found a fairly neat correlation between nominal GDP growth in the new series and credit growth, which is what should be, and we go by that. But it's not just GDP or the IIP that we depend on. We depend on a number of micro level indicators. IIP is the one we tend to actually avoid, because it is so volatile and so difficult to predict. But there are a whole lot of indicators that are available in the public domain that we use. And I think the GDP, the new series in nominal terms, is a reasonably good indicator of credit growth. So that's what we go by. So the bottom line is that with some contraction in, I wouldn't say contraction, some moderation in GDP growth in the second half, my advice, not just to our bank but to people who are interested in financial variables, is to sort of work with more subdued numbers for things like credit, disbursals, other financial things, because clearly there has been a contraction, there is likely to be a moderation, and that's bound to sort of filter through to things like credit demand and so on. And as I said, if there is a problem with the supply chain, that also sort of affects credit demand. So for us, the second half looks a little challenging, but on the other hand, liquidity has improved substantially, cost of funds have come down, so we'll have to sort of strike a balance between maybe moderately reduced credit demand and the fact that our liquidity situation is much better, and we'll have to sort of carefully look for avenues of deploying the improved liquidity or cash that we have on our books.
Okay, so clearly both Pronab as well as Abheek think IIP is a poor indicator of the level of economic activity in the economy. But I'm afraid on that note, it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing expectations of Q2 GDP numbers with Pronab Sen and Abheek Barua. Pronab, earlier we were talking about industry, agriculture and all the other sectors in toto, and particularly about IIP, we were not very sure of the numbers. But how much of a lift can one get from the agri sector, given that we had good monsoons? Or is it too early in the year to expect the better monsoon to be reflected in second quarter numbers?
No. The quarterly numbers actually do pick up the progress of the crops. That's how they're structured. So it will pick it up. I mean, I don't think there's any doubt about it. But where I disagree with Abheek is on mining. One of the downsides of good rainfall is that the mining sector takes a hit. It has to scale back its production. And since we had very good monsoons this year, I suspect the mining sector may actually show you weak results in the second quarter.
Okay, so you win some, lose some. But Abheek, if you look at agriculture, the fact that yeah, absolutely. But Abheek, agriculture now constitutes less than 20% of India's GDP. So purely from the GDP perspective, as distinct from the perspective of human welfare, how correct is it to attribute poor performance in the overall GDP front to a poor monsoon? And for the benefit of our viewers, can you spell out the various channels through which agriculture performance affects GDP?
Well, I think the link between agricultural performance and the other segments of GDP growth has become weaker over time, and there, other things have sort of substituted for agriculture. For instance, if you look at the very strong growth rates that we saw in the last decade, that period was marked by very strong exports, and we had periods of very poor monsoons and agricultural growth, but it did not have much of an impact on either industrial growth or top line GDP growth. So the dependence on agriculture has certainly ceased. But in a situation where the other sports have kind of disappeared because of global events, a slowdown in the global economy, I think agriculture and rural demand in general, which should not be confused with just agricultural demand or farm demand, because the rural economy is much more than just agriculture. I think that is playing a more critical role now in supporting demand, and of course it sort of contributes quite substantially to the input pool. Food being the principal sort of wage good, and then you have a whole lot of other things like agricultural commodities feeding through to the industrial sector. So the link is there. It's become weaker over time, but they're in a situation where we're not getting any sort of leg up from the global economy, and things are likely to deteriorate forward. I think we'll have to take a closer look at how better we can sort of manage our domestic sectors and the domestic sources of demand, and agriculture still remains fairly critical from that perspective.
So agriculture, even though it is important, is less important than it used to be before. But Pronab, if I can shift now from agriculture to construction, that is another sector that fared very poorly in the first quarter, just 1.5% growth. Since this is a sector that also has a huge impact on employment generation, the government has taken a number of steps to remove the bottlenecks here. For instance, it has said that 75% of the amount in dispute with government departments can be paid against a bank guarantee. When will all this result in better numbers in the construction sector?
Well, construction sector is in shambles. I don't expect better performance in the second quarter because, again, monsoons do affect construction activity as well. But the real issue in the construction sector is that a lot of your large companies are facing an enormous amount of stress in terms of their leveraging. And so there's a supply side issue there as well. So until the NPA problem is cleared out, I think one should hold one's breath as far as construction is concerned.
Okay, so until the NPA problem is solved, construction will not look up, and that's a big if. But Abheek, can we expect any support at all from the global economy, even if construction falters? Can the global economy come to our rescue? Because now the US is expected to do better under President Trump.
Before I answer that question, let me again sort of respond to Dr. Sen on both mining and quarrying and construction. I mean, in terms of the level of activity, things have might remain flat or worsen a little. But the limited point I was trying to make is that there is a very positive base effect at play here. And if you look at September, the growth rate for construction, for instance, for the previous year's second quarter, it grew by just about 0.8%. So even if you sort of maintain your growth rates at cyclically adjusted at the first quarter's level, you should get a bit of a bounce. But I think I'm sort of nitpicking a little too much. Let me sort of get to the issue of global demand. Yes, the problem is that with this specter of protectionism and so on, or whether sort of America looks more inward for both its production resources as well as demand and so on. I think the traditional link between US growth and growth in the rest of the world, particularly the emerging market economies, might just sort of break down to some degree. It's possible that Trump at the stump with his election rhetoric was a very different sort of creature from what he would be as president. But if he does sort of deliver on his rhetoric and there is this wave of protectionism goes around, you would see less imports, less offshoring being done by the US, less imports from the emerging world, and this would sort of, if this is done through tariffs, as is likely, then you would also see the specter of very disruptive trade wars, particularly with China. So I think some of the old rules have changed on with the results on 9th November, and I don't think a thumb rule that if the US does better, the rest of the world should do well along with it, is not entirely true to the degree it was earlier. So we'll have to be a little careful, see how US policy pans out. If it is on the lines of what Mr. Trump promised at his campaign speeches, then I think global support is going to be fairly limited for emerging markets. And that's why emerging market stocks and bonds have been one of the worst performing assets over the last few days ever since the elections, beaten only by the Mexican peso and American bonds. So that just gives you an idea of how apprehensive people are about the global situation.
So we can't expect much support from the global economy. And what about the domestic economy? Pronab, GDP growth this year was expected to be driven by consumption, post the pay commission payouts and OROP. Now will those hopes prove short-lived? How much will it be affected by the demonetization?
Well, frankly, Mythili, at the moment you have no choice but to depend on consumption. And if you take those two, which is the pay commission and the OROP effect, a fair amount of that can actually still convert into consumption through the plastic money route. So perhaps it won't be that devastating there. But given the kind of uncertainties that have been created, I don't expect investment activities to do anything over the next this and the next quarter until the economy comes back to an even keel. And whether the improved consumption is going to make up for what I see as a decline in investments is moot. I don't think it will.
Okay. Abheek, a quick response from you about the low levels of gross fixed capital formation and what can we expect in the second quarter, an improvement or a worsening on that front?
Possibly a worsening in the second quarter, but pretty much the same levels, possibly a little bit of worsening in the second quarter. But going forward, I think you brought up this demonetization issue, which I think is far more important than just dwelling on the second quarter numbers. And I think one of the pieces of this puzzle is what the government does with the profits that RBI apparently makes out of reduced liabilities. If it is transferred to the government, does it when will it be transferred, and if it is transferred, can the government use it to offset some of the negative impact, ramp up spending, or simply give cash transfers? There's this talk of putting money into zero balance Jan Dhan accounts. So I think that bit, which is I think legally a little controversial because apparently it's still not demonetization but delegalization. But if it's indeed full if the liabilities are legally extinguished, then there is a dividend claim that the government can make, and that dividend claim can be huge. And the deployment of that, I think, would fundamentally determine how things behave going forward. As Dr. Sen said, the private sector is too sort of beleaguered with uncertainties both on the domestic and the global front to be a major investor. The government has to take the lead. But the silver lining in this demonetization exercise is the possible, resource transfer to the government from the RBI, and I think that gives me a little bit of hope.
So as far as the private sector is concerned, we're not going to see any more investment, but I'm afraid we've completely run out of time, so I'll have to end this discussion here. I know that when it comes to GDP estimates in an economy as complex as India, it's not just difficult but close to impossible to call right. What is reassuring is that neither Abheek nor Pronab is as downbeat as some of the brokerages. So on that somewhat comforting note, let me thank you, Pronab, as also Abheek. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at @etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.